bar. We got a red bar on the awesome oscillator today. A red bar. Took out the 10-period moving average. We're still holding above the 20. We didn't get a bearish reversal of conditions yet. See if we get that before the week ends with the PCE data, or next week. We have a 3-day losing streak. We gapped lower today. We'll be watching the gap. But we get our first red bar here. Again, massive negative divergences have developed on the Nasdaq and S&P 500. Stochastic broke 80 now with our 3-day losing streak. S&P also dropped below the 10-period moving average, finding support at the 20-period moving average, getting our first red awesome oscillator bar, again forming a massive negative divergence on the MACD and on the awesome oscillator. The MACD is now getting a bearish cross. Today it got a bearish cross as the histogram here. Hard to see, it moved into negative territory. So again, you're likely going to see a bigger sell-off than what we've seen so far through the rally, but it's likely not over yet, as we'll get the final climax rally of the final phase of the blow-off top. We are in the final phase of the blow-off top from the April low. Next rally will be the final climax move of that. I expect the fourth quarter is going to be good, but you're going to sell off over the next few weeks here towards our 200-period moving average. The black line here, that's at 6,012 right now. Again, we got our stochastic that's rolling over in the weekly time frame, forming this negative divergence on this massive negative divergence on the S&P 500. You're likely moving back towards the 20 or the 50-week moving average. You'll probably drop below the 10-week moving average like Bitcoin already did, and the markets will follow Bitcoin's lead. Likely won't top until a divergence develops in this most recent price action here on the weekly chart. You'll probably see red bars, and then you'll probably see a rally that will eventually take us to new highs and end up forming a divergence on the awesome oscillator before all is said and done. You're likely going to get this pullback towards the 20 and the 50-week moving average here, maybe towards that 200 period moving average in the daily time frame or beyond it, which again, the 200, 50, near the 6,000 area, so something to be paying attention to. Please support the channel with the link directly below that allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel. Follow the link below to take you to a secured site. You can donate any amount you want or make it a recurring donation. If you do that, I thank you. Later in the video, I'll show you the weekly charts, and this is the weekly right here of the S&P, and trending signals, important resistance levels that we're turning off of right now. Now again, we're starting the post-Fed sell-off. I told you Bitcoin started it immediately. Bitcoin peaked the day after the Fed. Already dropped by about 8% from the Fed meeting. Formed a rising wedge, broke down, had the breakdown of the September sell-off. Now the market's following Bitcoin's lead. The warning signs, the same warning signs that we got on Bitcoin, we had in the market. I showed those to you yesterday, and now we're seeing the sell-off. The Dow was down. Dow was down There it is. 174 points, down 0.38%. The S&P was down 0.5%, right on the nose, down 33 1/4. The Nasdaq was down exactly 0.5%. The Russell down 1%, and the VIX was up 3.46%, up just about 3.5%. And there's the headline popping up there. Trump approves TikTok deal through executive order. So some TikTok news coming right up after the market closes. Now, we're seeing volatility with Oracle, with NVIDIA, the semiconductor ETF got a major topping signal. Couple of things in play. We're starting to see a tech sell-off. You've got the risk of a government shutdown. Markets don't like that. They get rattled. Even if it doesn't happen, going into October 1st, markets can still get rattled going into it. And if we get a government shutdown, there could be further volatility. Eventually, the politicians get this stuff worked out. It's just an excuse to sell. That's all it is. Oh no, we're going to have the government default on the debt. And it's just the same sell-off reasons that we always hear. And the politicians just comes around every so often. Nothing's going to become of this. We're going to have a sell-off surrounding it. It could be part of the catalyst, but then the politicians will end up getting things resolved. And if there is a government shutdown, they'll end up, it'll be brief, and then they'll end up reopening the government. It may not shut down if they can resolve it before the deadline. We'll see what happens. But back in 2011, a good example is that we saw markets rattled with that, and it dropped the S&P dropped 21% at that time. So that could be an issue. The Fed, as I've continued to warn, we can see yields begin to spike back up. We're seeing that happen right now because we're seeing signs that the Fed may not be needing to cut. I told you it is very possible it is one and done with the Fed cut, and the Fed cut is already priced in. That's why we're going to get a sell-off. We're going to get a post-Fed sell-off. It's already starting. Let's start with Bitcoin last week. We're now starting it with the stock market this week. I warned you, the rate cut was already priced in. If the two more cuts that are expected for this year are taken off the table, that can add to the volatility. What could do that? An improving economic outlook, which is what we're starting to see. Exactly what I told you would likely happen, and we'll probably see an uptick in inflation. Tomorrow we'll get the inflation data with the PCE inflation. Even if we don't get that tomorrow, you get the CPI coming after the jobs report in October. Probably going to see the jobs report begin to show signs of improvement. Jobless claims tumbled to 218,000, better than expected. It was expected to come in higher. This is well below the estimate, despite fears of the labor market having weakness. Again, you're probably going to see the jobs reports begin to improve. What reason is there for the Fed to cut, as I keep saying? So then the two cuts for this year are taken off the table. Again, I'm being mocked for saying this on social media, that the markets could go into shock. We can have a sell-off right now. If the data improves, the economic data improves, the labor market improves, seeing that happen could go into shock as the penciled in rate cuts are taken off the table. Inflation's rising and the economy is fine if we're seeing improvement in the labor market. Why does the Fed need to cut? Now, the Fed should be cutting. Don't get me wrong. They should be slashing rates because a recession is coming. Have the warning signs, but Powell and the folks over at the Fed, they don't believe those signs because they're a bunch of Keynesians. They run around saying things like there's no housing bubble or inflation is transitory. They caused the inflation with their policies. They want to blame it on supply chain disruptions, and it was their policies and government deficit spending that caused the inflation. So worried about the tariffs causing inflation, it is their policies that cause inflation. They want to look for the inflation boogeyman, they need to go look in the mirror. So again, we see improvement with the jobless claims. Right before the Fed cut, it was 263 or 64,000 or something like that. Ticking up. Now it's ticking down. It's improving. Then we get the GDP. Powell's telling us how weak it is. We get the second quarter GDP revised up sharply, 3.8%, the strongest in 2 years. It was revised up, growing at the fastest pace in 2 years. Explain to me, why does the Fed need to cut? This is the reason, this is the excuse the Fed is giving us that they're cutting. Why do they need to cut? I think they should cut because I know recession is coming. It's not coming. We're seeing strong GDP. Markets top on good news. The unemployment rate has been low. Eventually, you're going to see negative numbers. We're already seeing one small negative number. Eventually, like in 2008, you'll get all negative numbers. GDP will eventually become very, very weak and go negative. It's top on good news. Usually, there are warning signs with the recession indicators. That's why I say the Fed should be slashing. But based on their thinking, there's no reason for them to cut because they're concerned about inflation. They're concerned about the weakening economy. Well, that's going by the wayside now. As I warned you, it was likely going to play out that way. If that's not enough improving economic data, we get durable goods. Before the market opened, durable goods was supposed to come in negative 0.4%. Previously, it was at negative 2.7%. Oh, and it rebounded back to positive. It was expected to be negative. It came in positive 2.9%. A good durable goods report. And here's the jobless claims. It's expected to come in at 235,000. Came in at 218,000. Not as much as expected and lower than the previous reading. Again, right before the Fed, it had ticked up to about 263,000. Told you what happens if we start seeing the labor market begin to improve is very likely right before the recession happens. We're getting the warning signs. There is deterioration in the labor market. But eventually, you're going to start seeing some positive reports. Right now, a strong labor market is bad news for the stock market. That's why the jobs report next Friday is probably going to come in strong and will likely rattle markets in all likelihood. And here's that third estimate for GDP. Again, it was expected to be at 3.3%, came out at 3.8%, much stronger than expected. Previous estimate was 3.3%. Supposed to hold steady. It didn't. It came in better than expected. Again, the quickest improvement with GDP in 2 years. Tomorrow we're going to get the PCE inflation data. If it comes in hot, again, markets could sell off. Concerns, inflation is rising, the economy is improving, so why would the Fed need to cut? PCE inflation data is expected to come in on a year-over-year basis 2.7, higher than the 2.6, and the core is supposed to hold steady at 2.9 on a year-over-year basis. We'll be watching that. Next week we'll get the jobs report. They don't have the estimate for the jobs report for next week, but if it's better than the 22,000 that we've got and the revisions downward, remember we got that negative number for June of negative 13,000. Start seeing a strong jobs report, start seeing improvement. What happened right before the 2007 recession? Negative number, and then you started seeing improvement. The stock market went and made new highs. You're probably going to see a sell-off. Hopes begin to get dashed that the Fed is going to cut. Cuts that were being penciled in with Fed Fund futures and with the dot plot probably aren't going to happen. This is going to shock the market. Fed cut 1/4 point. It was already priced in. People online saying, oh, we're going to get all these cuts at the Fed. This is so bullish. Here we go. It's already priced in. Cuts that are supposedly coming, the 2 cuts that are coming, likely not going to happen. I think that we'll end up getting the Fed doing jumbo cuts, but I think it'll be in the first quarter after we get a spectacular fourth quarter and the markets begin to crash. I think the Fed will panic. I think we'll sell off here into earnings, and then I think you're going to get a really good fourth quarter. Volatility right now. Right now, they're still expecting a cut. October 29th, 87.7% chance. At December, 60% chance. These could go bye-bye. If we see improvements with the labor market, again, we're seeing now improvements with the GDP. If we see the jobs report next Friday, this can go away. If we see the GDP, if we see the inflation begin to tick back up tomorrow and then later with the CPI, that's where we stand. 2 cuts are expected at the moment. I think they'll eventually go away. A 1% jump on the yields. It moved off of that by the end of the session, turning off of this trend line. You have a bullish falling wedge. The yields are rising. Why? Why are the yields rising? Fed's cutting, and yet yields are rising. I told you this could be a factor. Rising today because, again, dollar and yields are rising. The economy showing signs of strength. Why does the Fed need to cut? Eventually, again, I think you're going to try to go and make new highs and complete wave 5, but you've got a bullish falling wedge here, and right now you're turning off of this trend line. We'll see if we can get a breakout of it in the near future, get back above the 200 period and start moving towards the resistance zone and this declining trend line right here. Risk is in the future that we still get Jamie Dimon's crack in the bond market where we see a collapse in bonds, yields spike up, which eventually could be one of the catalysts for the market topping. We'll see what becomes of our bullish falling wedge here. Rising yields could be also a catalyst for a sell-off in the market. They have oftentimes a negative correlation with the market. The yields rise, the market falls. They have been rising since the Fed meeting. Fed cut. Fed funds rate deals with short-term rates. The 10-year, the 30-year, these things deal with the longer-term rates. Longer-term rates are rising. Fed is cutting. Start seeing inflation data tick back up as I predicted. A bottom for inflation with the CPI. I predicted it to rise. It is. It could also be a factor in yields rising. It was down 0.43%, down 106 points today. We're turning off of the trend line here from these recent highs. This trend line goes all the way back to the 2020 low, and it's forming a massive broadening formation on the Nasdaq. every time we've hit this trend line going back, here you fell almost 16%. Over here, you fell almost 26%. This is going to give us some kind of sell-off. I think you're going to sell off towards the 200 period moving average. If we just go down, as I talked about yesterday, if we just go down to get a sell-off like we had back here in July, you're looking at a 16% drop that takes you down beyond the 200 period moving average. I have a more smaller, mild pullback marked here. Could be something bigger towards the 200 or something beyond it. But again, I think you're eventually going to sell off and then go to a final climax high up to this trend line again, in my personal opinion. But this broadening formation, you can see it here on the daily chart. Here it is on the weekly chart here. I've marked a bigger corrective move beyond the February high right here, back towards our 50-week, maybe back towards that 200 period in the daily. However, and again, if it's just as much as this, then you are going back towards the 200 period if we get a 16% sell-off. And that was over about 2.5, 3 weeks that happened. It was just a few weeks. Well, pardon me, 4 weeks. It looks like that bottoming reversal bar was the 4th week we sold off when we bottomed there. So 4 weeks, pardon me. But this is what I think is happening. Eventually, I think this broadening formation, which NVIDIA is forming one too, will eventually play out. We'll see a top. Here's the broadening formation on the weekly chart. This is our linear scaling. Here's the broadening formation, the lower boundary, the upper boundary. If you go back all the way, here it is to the pandemic low. Line acted as support over here, got rejection at the 20-week. We dropped below it. Rebound, we peaked at it in July of 2024, and then again tagging it in late 2024, giving us that sell-off. We went slightly higher, not reaching it. That divergence eventually formed on the daily charts and gave us nearly a 26% sell-off. It was like 25.5% or so. So we've had significant declines off of this trend line. We'll be watching to see what happens here. I think you're going to get a pullback and then probably get one more push into it in the 4th quarter. We're likely going to get a reaction off of this trend line. As we hit it, saw warning signs, and Nasdaq formed a topping signal like Bitcoin did back at the top on August 14th, and then like we just got the day after the Fed meeting, 2 days after the Fed meeting, we got the signal, what we got on Nasdaq. Today, Bitcoin's dropped nearly 4%. Right now, just under that, but again, it's dropped nearly 8% since that warning sign. We're going to see the semiconductors and the Nasdaq do the same, and more selling with NVIDIA and Oracle. The same warning sign that we got on Bitcoin at the top and the lower high that was made there just after the Fed meeting, got the same warning here on the Nasdaq as we slammed into that trend line and turned off of it, and now we're turning down. Today you get a candle of indecision in the form of a spinning top or down. We have a 3-day losing streak for the market, and we're getting this week the post-Fed sell-off that I warned you about. Again, we had an options expiration last week. We went up. But I told you after options expiration, we're likely to see the post-Fed sell-off, and Bitcoin had already started it last week. Nasdaq daily chart. Got the same warning signal with the semiconductors. Here's a semiconductor ETF, SMH. And again, the same warning sign that we got on the Nasdaq. We dropped 10% in July. If the S&P were to drop 10%, that takes us back towards the 38.2 Fibonacci, towards 6,000. If we do that, we could drop towards the 200, which right now is at that level. We could be dropping below the 200 period moving average. Above that, we have the upper boundary horizontal support there from the February peak. Something bigger than that, or 50% retracement, is just below 5,800. Have this divergence, this multiple point divergence on the RSI. Now we have this 3-day losing streak ahead of the PCE inflation data. Signs that the economy is improving, the economic data is improving. As we're turning down, the S&P 500 turning off of the 2023 trend line right here. Now, again, right here, if you connect this low and this low right here, we didn't quite reach it right there, and we were hitting that level in July and August. We pushed up through this trend line, and if you exclude this bar right here as an overthrow and connect it to this trend line right here, this low right here, then we're slamming up into it right here, right now. So we had to push above this trend line only to reach this one right here from the 2023 low connected to this low here and a slight overthrow there. And that's where we're hitting right now. What I'll be watching is, do we come down and take out the red trend line? If we exclude the bottoming tail from the September low, you're coming up to that area right now. You're coming down, I should say, to that area right now. This was the low in May. This was the low in June. Here in the summer months, you break that trend line, it opens a door for a bigger sell-off. Not only is S&P at this trend line right here from the 2023 low, just turned off of our trend line from the run up in September that formed this rising wedge. We turned off of that level, forming multiple point divergences. You can see it here on the 15-minute chart. And now today we gap lower and we get the 50 crossing below the 200. We're below the cloud. We're below the 50. We're below the 200. We may try to fill the gap. We'll be watching what happens with the PCE inflation data. But again, you've broken the trend line and you've taken out the 50 and the 200 here in the 15-minute time frame. The negative divergences played out, and we're starting to see a sell-off. At that peak, the S&P lost the 200 period in the 5-minute time frame. The 50 also crossed below the 200, like on the 15-minute chart, and now the 15 has followed suit. Any rebound back up, we'll be watching the gap that we had today. We'll be watching the 200 period moving average to see if we do attempt a recovery with the PCE data. There is a little divergence here in the 5-minute time frame. So again, a gap to be paying attention to up here at the 6638 area or so, just under 6640. P lost 0.5% today, a 3-day losing streak taking us below the 50 period. We'll be watching, do we eventually try to move down here towards the 200? We're here right at the cloud. We tried to dip below it and then kind of closed right at it. The cloud is turning bearish into the future. It's rolling over and turning bearish. You get a good drop below the cloud. Again, it's going to be major resistance along with our 50 period, which is now rolling over. Eventually, you got to take out the 50 and the 200 and have them get a bearish cross. The divergences in the 60-minute time frame are playing out off of the upper boundary of the rising wedge here and that resistance from the 2023 trend line that I showed you earlier. 60-minute chart hasn't broken the cloud. The 30-minute did. We're testing the 200 here. Again, if we rally back to try to fill the gap, the cloud is resistance with the 50 period here in the 30-minute time frame. Again, the intraday charts, we broke down from these rising wedges, turned off of the upper boundary of resistance. Now here, the cloud and the 50 period are resistance here. Trying to get a bullish cross towards the end of the session. We'll be watching. Do we try to fill that gap with the PCE data and get a counter trend, a larger counter trend right here and now? Are we completing a 5-leg push lower and we'll get an ABC move back up for maybe a lower high? Or is this sell-off not yet done before we get any kind of meaningful bounce? We'll be watching what happens with the PCE data. Comes in cool. The market might try to breathe a sigh of relief and get a relief rally. Comes in hot. We could see the selling continue. But if we do rally back up again, it very well just could be the gap fill and a counter trend before more selling as we go into next week if we do attempt to rally with the PCE data. Diversions play out on the RSI here in the daily time frame just as it did back over here in February of 2025. And again, you've got a potential larger rising wedge that we're closing just slightly under that trend line. You've got the negative diversions playing out that's likely going to take us back, again, either towards this horizontal support level here or towards our 200 period moving average. You get a 10% drop like in July of 2024, then you're looking at 6,000. This peak over here is the 6150 area. So again, we'll be watching. These support levels are 100 or 200 period moving averages here. But again, you're likely getting a wave 4, and then you're probably going to go up and get wave 5. You see the larger rising wedge here on the weekly chart as well. Again, eventually I think we're going up to the trend line here. If you include the shadow over here for 2022 with our log scaling, this is the trend line where I think we're headed. The upper boundary is pointing up into that area as well. So I think you're going to pull back towards the 20-week moving average right here, the 50-week not seen on the chart, and then I think you're going to go up and hit those levels. This is our log scaling, hitting the trend line from the 2023 low on the linear scaling I've shown you on the daily chart. Here it is again. If we slightly overthrew this trend line right here, but tagged the trend line right here, we're slamming right into it. And this trend line going all the way back to the 2018 peak right here, potentially a channel line. My guess is you're going to pull back to the 50 or the 200 period moving average here. I'm sorry, the 20-week moving average and the 50-week moving average. And then I think you're going to try to rally back up into the red trend line. We haven't reached the red trend line or the blue trend line, which excludes the shadow down over here. This blue trend line right here, the dotted blue one up here. So that's eventually where I think we're going to form this longer term channel from the 2020 low. You can see right here, this lower boundary and the horizontal support is what marked the April bottom. I think the upper boundary with the red parallel trend line here or the blue one will eventually mark a top. We haven't reached it yet. We'll pull back and likely reach it. Point diversions like we did back over here at the February high on the RSI. MACD is now rolling over. Massive diversions on the MACD, getting the bearish cross today. We didn't get it yet on Nasdaq, but again, if we start to sell off, we could see the Nasdaq get the bearish MACD cross too, and we'll see what happens. So far, the pullbacks have been very mild. Signals have been consistently bullish. You start taking out the momentum cloud here. You start taking out the 20 period, which has been acting as support. That 20 period, the momentum cloud over and over again, all the way up. It's acted as support. You start taking out that level, then you start moving back to the trending cloud towards horizontal support, towards the 100, the 200 period moving averages. The bearish cross here, possibly completing that divergence for a larger sell-off now. Don't have it yet on Nasdaq. Resting on the 20 period moving average in the cloud. Those levels have to break for a bigger sell-off with S&P. Don't have the MACD rolling over yet here in the daily time frame for the Nasdaq, so we'll be watching that. Nasdaq did get a turn off of major resistance, as I'm showing you in the video. We did get a sell signal for Nasdaq at that reversal level. Some warning signs. The signals had to flip back to bearish. Sorry, a little sore throat. I was sick over the weekend. I'm still recovering. Sorry about that. The 20 period, we're still above it. The cloud, we're still above it. And if you get the bigger sell-off, watch the 200 period. Watch the horizontal support level here. So we'll be watching if our high holds at the resistance level from the 2020 low, the trend line from the 2020 low on the Nasdaq. I think you'll see a sell-off, and then I think we rally. And I'm just including this trend line. You can see it here on the chart, but I think it probably goes out further. I have it ending here in November, so you can see it, but I think it goes into December, maybe on into January or February. Certainly possible. I think also for the S&P, like the S&P, we're going to get the wave 4 and then get the wave 5. And I think the stock market will peak. I think Bitcoin will peak in the coming months ahead together. Oftentimes, Bitcoin peaks ahead of the stock market, so something worth paying attention to. If we turn off the resistance levels I'm talking about in this video, these longer term resistance levels are the resistance from our rising wedge with the 60-minute chart. We got to see all the signals begin to turn back to bearish. This is the S&P daily. Nasdaq daily. Again, signals have been consistently bullish. Nasdaq had a couple of bigger downturns in the summer. Signals have turned back to bullish. We got to see them turn bearish if we're going to get a bigger sell-off. Candles of indecision really today on the S&P and the Nasdaq in the form of spinning tops. Nasdaq daily here still bullish. I've gotten warning signs, topping signals. If they're to play out, we've got to see signals turn bearish to validate those signals. S&P 500 signals turn bearish before the weekends or on into next week. Be watching today's gap. Is it a gap and go, a gap and fill, or a gap and trap? See what happens with the PCE data. Now, if we sell off further tomorrow with the PCE data, Nasdaq could turn bearish here. Again, consistently bullish since the bottom. Had a couple of sell-offs over the summer there, and then we went higher in September. Bitcoin's already ended the September rally. Nasdaq's likely going to follow suit here. If we take out and close below today's lows, you'll likely see the signal here turn bearish. Same for the S&P 500. If we take out and close below today's low, you will likely see these signals flip. If that happens on Friday, we bounce and go back to fill the gap, then we can break them by next week. But again, signals have been consistently bullish on the S&P 500. Nasdaq signals flipped back to bearish in August, mid and late August. S&P did not. Again, we break below today's lows and close below them on Friday, you're likely going to start flipping trending signals and momentum signals back to bearish. I warned you the VIX had broke out. We saw topping signals on the S&P. It broke out, got back above the 50-period moving average. When that happens, bad things start happening on the S&P. The Bollinger Bands are tight, telling us something's about to happen. That's what happened over here before we exploded higher with volatility and saw the big sharp sell-off from the February high. And you've got the same thing going on. The MACDs turned positive over here in February. You got the hollow red candlestick. MACD turned in positive territory. You're above 50. So again, I expect you're going to see an explosive candle here tomorrow or next week. At some point, you're going to see it. We tried to get it. We started to try to get it today, but we didn't close at the highs. Still ended up 3.5% higher, but this is warning us that we're going to see volatility return. This is the first time we've had the MACD move into positive territory after being negative for a while since back over here. The last time that happened, we got the peak in February and a 21% sell-off on the S&P, nearly 26% sell-off on the Nasdaq. The S&P so far, right now, on Thursday, is down 0.89% for the week. It went higher, got a topping tail. I'll be watching to see what does this bar look like by the end of the week after our winning streak in September for 3 weeks straight. We'll be watching what kind of bar we get. The weekly time frame as we're turning off major resistance. Same thing for the Nasdaq. Hitting major resistance, we're down 0.93% for the week. We have a 3-day losing streak. We'll see. Do we get a doji, try to rally back up and fill the gaps, or do we get something uglier? But it likely depends on how the PCE data comes in tomorrow morning. Watching these weekly charts. If we get a rally, we could end up with a doji. Right now, you got a possible spinning top. We sell off with the PCE data or rebound back up to try to fill today's gap. If you do, you might get a doji. Now you have a spinning top. Thing on the S&P, going back to the S&P, you got a spinning top right now. If you rally back up, you get a doji. If you sell off further, we're going to start seeing trending signals turn bearish.